Without owning and managing your own rental properties, there are two main ways to invest in real estate. The first is real estate crowdfunding, and the second is REITs, or real estate investment trusts. Welcome to Financial Fluence. In this video, we'll go over how to make money by investing in REITs. When crowdsourcing real estate, several people pool their resources to form a fund that offers them access to a limited number of real estate properties. You usually have to use a crowdfunding provider because you can't buy crowdfunded real estate on the stock market, and you can't get your money back from a crowdfunded real estate fund regularly and for an extended period of time. A real estate investment trust is a company that invests in real estate investment properties. REITs, unlike crowdfunded investments, can be bought and sold on the stock market at any time. Investors are more likely to put their money into real estate because it can generate a fairly steady passive income. Let's say you spend $100,000 on a property, a renter moves in, and the tenant begins paying you $1,000 per month to live there. On the other hand, owning and running your own rental properties takes a little more work because, first and foremost, you need money to buy the property, and second, you need a team that includes real estate agents, contractors, lawyers, accountants, and property managers. Because you can invest in a REIT, a business that now invests in real estate and makes money from rent, it is a little more difficult, which is where reading is helpful. The good thing about REITs is that they have to pay shareholders dividends equal to 90% of their taxable income or rent. Real estate investment trusts make money by buying property and renting it out to other people. So they take all of the rental money and pay their bills. Then they take 90% of the remaining money and distribute it as dividends to you and other shareholders. As a dividend, a corporation will pay you cash. To avoid having to go out and collect rent from tenants, you can invest in a business that will handle the work and maintain the property. Dividends will be paid out as a percentage of the company's earnings. REIT funds are a popular investment option. REIT stocks are a great way to make passive income because they often pay higher dividends than other stocks. If you put $100 into a real estate investment trust that pays 10 dividends a year, you'll get $10 this year. There are a few things to consider before buying a REIT, simply for the large income. Understanding dividends, the type of REIT, and the investments it makes is essential. When you buy a REIT with a high dividend yield, the dividend payment date, or ex-dividend date, comes up often. The REIT stock price often falls in direct proportion to dividend distributions. So, if a stock pays a $20 dividend and is trading at $200 per share, you stand to make a lot of money. The day the dividend is paid, the stock share price will drop to $180. Since we pay dividends, the stock price will go up to reflect the tax dividends you get. If the rate is very strong, investors will see the company's loss as a chance to buy. Dividends from REIT stocks are frequently taxed differently than dividends from other stock classes. The long-term capital gains rate, which is normally quite low if you purchase a stock that pays a dividend, applies to the dividend you get. The ordinary income tax rate you pay on your salary is often significantly higher than this long-term capital gains rate. The IRS suggests a slightly different approach to paying taxes for REITs. The government backs REITs because they pay high dividends. You will not be able to use the special reduced tax rate on long-term capital gains. Instead, you will pay the standard tax rate, which is the higher tax rate on REIT dividends. If your tax file is handled by an accountant or tax preparer, you should not be concerned because it should be calculated automatically. I only tell you this so that you can understand how the tax system works. I should make it clear that I am a lawyer. Because I'm not your lawyer, you should consult with a local tax professional if you have specific tax questions. To find out how much a REIT or any stock pays out in dividends, use any stock analysis website or a free stock brokerage like sponsor Webull. So, what happens if I enter AGNC, the stock I showed you earlier, into Webull? When I open this, I see that the dividend is $1.44 per share, based on the current share price. We're making this video at a yield of 10.12%, and I'll compare it to another REIT so that I can see that this stock pays a respectable dividend when I go to SPG and open this up. If you find an investment you like, you can buy or sell any stock or ETF from their app or computer for free. The $5.20 dividend per share represents an 8% yield based on the current stock price. Before we continue, only a small portion of the viewers of my videos actually subscribe. If you find this video helpful, consider subscribing with notifications enabled. Let's return to the video now. Now, let's look at the various rate categories. On the one hand, there are equity rates, which are rates that own and operate income-producing real estate. Mortgage rates, on the other hand, invest in loans and mortgages and profit when property owners and landowners pay interest on their debt. Each type of real estate investment trust carries its own set of risks. I mean, the mortgage market, like the real estate market, will go through cycles, with some mortgage rates investing in riskier loans and others investing in riskier properties. Being a mortgage lead or an equity rate doesn't change much, so you should know what kind of investment you want. You can research the types of investments that these rates make if you are familiar with the various types of rates, such as equity rates. Rates that own and manage their own real estate will invest in residential properties like apartments and homes, unlike rates that would invest in institutions like hospitals, office buildings, and shopping centers. Think about the kinds of homes you would purchase if you had unlimited funds. I'll say it again. Don't buy a real estate investment trust just to get a high dividend yield. A very high dividend yield could mean that a business is doing well and the stock price hasn't caught up, which is excellent, or that the business is struggling and the dividend hasn't been increased yet, which is negative given mortgage rates. In contrast to commercial loans, high-risk mortgages, and commercial mortgage-backed securities, some mortgage rates will invest in mortgage-backed securities. Many investors believe that when they buy rates, they are buying a ticker symbol rather than a corporation. This can happen to any stock, but rates are especially vulnerable. People might believe, for example, that this company pays a 10% dividend every year. Please allow me to invest all of my money in stocks, which I believe will return 10% over the next 10 years. You will lose money if the stock price falls by 20% per year while paying a 10% dividend. However, if you are an experienced investor, you may still be able to profit. Due to the company's successful acquisitions, you are now investing in a strong company, which means you can benefit from both rising stock prices and dividends. You've now won 2 straight games. You're not alone if you've watched this far and are thinking, man, I'd really like to invest in a real estate investment trust. If you don't trust yourself to do the research, don't know how to do the research, or just don't want to spend the time doing the study, a REIT ETF could be a viable alternative for you. An ETF is a type of mutual fund that invests in a wide range of companies. As a result, rather than seeking the best investment rate, you can now invest in a REIT ETF, which is an ETF that invests in a variety of rates. Real estate investment trusts let you invest in the real estate market without having to own and manage your own investment properties. You can get your money whenever you want. This is not the case with rates raised through crowdfunding. Following business and financial news, like everything else, can help you make the best financial decisions. And that's all. I hope you enjoyed this video. If you enjoy similar stuff, check out my other videos. And if you like it, hit the like button, subscribe to the channel, and turn on the notification bell. And I'll see you in the next video.